The stock market is dropping, so are we finally at the darkest hour? Well, that's the million-dollar question. Are we in a short but painful correction, or is this something much more? To better understand this, we have to ask two questions. What's the market afraid of? And two, are the market's fears valid? To me, there are two obvious reasons the markets are jittery right now. One, there are several conflicts/wars happening in the world right now that could easily escalate into a much worse situation. And two, the markets are afraid the Fed won't lower rates. But is this a reason to sell stocks and treasuries? The fear of an escalating war is understandable, which is why I think gold has been performing so well over the past couple of months. But is the fear of the Fed justified? Back in 2022, the Fed was making it very clear that they were not only raising rates, but that they would continue to do so until inflation came down closer to their target of 2%. Well, how does that contrast with where we are right now? Well, now the Fed has signaled and continues to signal that they are done raising rates and they fully intend to start lowering them later this year. Now, this headline leads you to believe that they won't start until March, but they're not talking about the Fed here. They're talking about economists and strategists. So, and they're not saying till next year, they're saying at least until September. So this is a little bit misleading, and nobody knows when the Fed will start cutting rates. And we'll look at what the markets think later in this video when we get to the Fed rate monitoring tool. For a more sane look at this situation, in my video last week, I played a section of Kathy Wood's In the Know video where she made very compelling arguments for why inflation and the CPI should continue to decline and possibly even go negative. I'll put a link to my video from last week and a link to ARK Invest's In the Know video in the pinned comments below. The wall of worry is clearly getting higher, but I think the current downward moves in the stock and bond markets should be limited unless geopolitical risks increase and or the Fed starts signaling they actually will consider raising rates. Now let's take a look at what the charts and metrics might be telling us right now. Well, if you take a look at the equity markets over the past week, you can see that all of them finished negative. In fact, the S&P 500 finished down about 4%, NASDAQ down about 6%, and ARK Innovation almost 10% down. What if we take a look back over the past month? Well, if we look back over the past month, you can see that if you want to call this a correction, at least in terms of the past month, the S&P is down about 5%, NASDAQ's down about 6.5%, and ARK Innovation is the big loser here, down 16%. If we take a look at year to date, most of the indices are still slightly higher, but the riskiest baskets of stocks, small caps and ARK, are down quite a bit. And this plays into that fear of the Fed not lowering rates. And then if we look back over the past year, yeah, we still have a reasonably healthy rally here, but you can see that returns are starting to fall. And what about the current bottom dynamics? Well, if we take a look at the current bottom dynamics, you can see that we have a very strong bottom forming indicator here, and the confidence level is fairly high. So we're close to a bottom confirmation signal here. I don't think the metrics in my model have yet triggered a bottom forming indication, but they're really close to one. And you can see the way the S&P has been pulling back. And if I overlay kind of the slopes here, you can see that we had somewhat of a rally here, and then it softened, and then it flattened, and then it started to trend downward, and now it's trending downward even more. So this is not looking great. What about risk versus opportunity? Well, this is an interesting picture. Now you'll notice I've added another graph here on top of this, and we'll get to that. But let's look at risk acceleration, which really is sending horrifying risk signals here. You can see that not only is it shooting higher, it's above 80. This is really not a good place. And look, that's indicated in the price movements. The price has been moving down. And what about opportunity level? Well, the blue line's opportunity level. Now that's a laggy indicator, and you can see that it has been declining since way back here before this started to decline. So that was somewhat of a signal that things might go lower. Now, if we look at the red line risk, that's also a very laggy indicator, and it's come up here and kind of started going sideways. Now, what's this new purple line? Well, I said to myself, we're looking at risk acceleration in the yellow line. So why don't we look at opportunity acceleration, which will give us a more relevant indication of what's happening right now. And you can see what happened here. Opportunity acceleration peaked out here and started pulling back well before this price peaked out. So this was kind of a divergence here that was kind of telling you things weren't going to keep going well. And now where are we right now, though? Well, interesting. Even though risk acceleration is moving higher, opportunity acceleration is also moving higher. So hopefully this tells us that we're at or near the end of this downward move. Now, there's no guarantees, but I do like what I see here. It's not saying things are totally bad yet. And what if we look at equity versus safety? Well, let's go right into the overlay. So if we look at the overlay, you can see cash and gold are right up here, number 1 and number 2. And you can see that the NASDAQ really collapsed and small caps really collapsed. Absolute bottom, dead last here. This is not looking good at all. And what if we look at the S&P 500? Well, again, not looking good at all. The S&P 500 has been falling down in the rankings over the past several weeks. But there is one small bright spot here. And what is that? Well, if we look at the Dow Jones Industrial Average, it's still showing an appetite for equity risk, although it's showing an appetite for safer equity risk. So the good news is that investors are putting their money into safer equities here and getting out of the riskier equities here. But you'd like to see the risk appetite be more healthy and investors putting their money in the riskier equities. But this is the one bright spot that that investors are still investing in equities, just not the riskier ones. And what if we look at safe haven assets? Well, you can see that for the last 7 weeks, gold has been up here at number 1. Cash has been in number 2 for the last 3 weeks. Short-term bonds, number 3, and so on. We have an unhealthy Treasury market with the longest duration Treasuries right down here in 9th place, and so on. So not a healthy risk appetite for Treasuries. And what about the buying and selling pressure? Well, there might be another bright spot buried in here. Well, we've actually already talked about the Dow. You can see that the price was declining for the Dow, and it bottomed out back here and has started to increase. And what's happened to the selling pressure, this solid orange line? Well, that has started to collapse. And the buying pressure, the solid gray line, has started to increase. So that's showing you kind of what we saw in equity versus safety, where the Dow has moved up in the rankings. Now, if you look at the S&P 500, price is just collapsing, and the selling pressure is increasing very rapidly, and the buying pressure has collapsed. That doesn't look good. NASDAQ 100, same picture, collapsing price, increasing selling pressure, falling buying pressure. Now, normally I put ARK Invest in here, but I wanted to show small caps. Why? Because if you see this, the price declined, and just kind of like the Dow, it has started to show some life here, and the selling pressure has started decreasing while the buying pressure has increased ever so slightly. So maybe there's some hope here. Maybe there's a bright spot in this data. Now let's take a look at ARK. Well, ARK's not looking like a bright spot. You can see that the price is absolutely collapsing, and the selling pressure has been increasing and is really shooting higher here as of late, while the buying pressure is at 0. That's as low as it can get, folks. So hopefully we're kind of nearing the end of this. And what about sector rankings? Well, these take a longer view, but if you look at last week here in this top table, we had, Bitcoin and technology up at the top, gold up here, no surprise, NASDAQ 100 here, consumer staples ahead of consumer discretionary. So you really don't want that relationship. You want consumer discretionary ranked better than consumer staples. But, cash and treasuries were all down here at the bottom. Now, if we go to this week, you can see that gold has moved up. Energy has moved up a tick. Bitcoin's still up in first place, although I don't think that's going to hold based on what I'm seeing there. And then you can see that consumer discretionary moved up a notch, consumer staples moved down a notch, but cash moved up and treasuries moved up. So kind of a mixed bag here in terms of how things are looking. Let's go to sector rank acceleration because this gives us a shorter term view. And you can see that last week gold was way up here with energy, no surprise. The surprise was a consumer discretionary was way up here and cash was way down here and treasuries were up here. So I guess the hint here is that treasuries were kind of up here in the top half of this table, which you really don't want them there. That's kind of a flight to safety. So let's take a look at this week though. Gold in first place, cash has moved way up, not good. Consumer discretionary fell back. Treasuries actually moved up a notch and consumer staples surprisingly moved down a notch. So this is saying that things aren't all that great. And just how have treasuries performed over the last week? Well, you can see that they really fell off back here on Monday and then rallied pretty much going into Friday. Now, they didn't end up, at least some of them didn't end up the week positive. The longest duration ones still ended up negative, but I like the trend here. I like it on one hand that there's an appetite for longer duration treasuries starting to show up here. This can also be a signal that there's a flight to safety, so that's bad for equities. And if we look back over the past month, you can see that all of them are down over the past month. And then year to date, we're pretty close to the bottom here year to date. And if we look back over the past year, you can see we're not at the lows we were at back here, but we're getting close. So when the Fed starts to reduce rates, these should act very well. And in order for this one to get back to just zero, it has to go up 25%, which is a big gain for a safe haven asset. And what about the buying and selling pressure for treasuries? Well, you can see that short duration treasuries have kind of gone nowhere here. And you can see that while they've gone nowhere and the price has been declining, the buying pressure has been quietly increasing very slowly here, while the selling pressure has been decreasing. That's actually positive. What about intermediate treasuries? Well, much stronger price decline here. And yet the buying pressure, the solid gray line, has been somewhat on an increasing slope here. So maybe things will start to improve. What about 7 to 10 year, what I call intermediate to long duration treasuries? Well, here the price has been declining, but unlike up here at short duration and intermediates, the selling pressure has been increasing and the buying pressure has been decreasing. What about long bonds, 20-year bonds? Well, the price is really falling here. But what I do like, and I actually like that back here as well, you can see that the selling pressure is starting to collapse. And here with the long bonds, it's starting to collapse and the buying pressure is starting to increase. So hopefully these will start to be a little bit more healthy going forward. And what about that inverted yield curve? Oh, I thought they weren't going to show me shoes anymore. Well, I like the pants better. Anyway, so if you look at this, the yield curve has become a little less inverted. I think last week it was 38 basis points inverted. Now it's about 35 and a half, call it 35.6 basis points inverted. Why did it get a little less inverted? Well, it's not because rates came down at the short end down here. They actually went up, as you can see. But what they did is they went up even more at the long end. So, there's two ways to uninvert this yield curve. One is for rates at the long end to go up a lot, and the rates to stay put here. Another one is for the Fed to start lowering rates because they control the rates down here at the short end. And if they do that, these rates will fall, and hopefully these will either stay put or come back a little bit as well, causing these long bonds to go up. So what do the markets think of what the Fed might do when they meet in May? Well, you can see that the markets are pretty solid that the Fed has no intention of lowering rates in May. What about June? Still very unlikely that the Fed will lower rates in June. We get out to July, it's still more likely than not that they will leave rates exactly where they are. Now, when you get out to September, there's more than a 50% chance here that the Fed will lower rates by some amount. And then November, right after the election, you've got more than a 75% chance here that the Fed will lower rates by some amount by then. So, the markets are acting as if the Fed's saying, hey, we're going to raise rates, but you can see that the market itself believes that the Fed will eventually lower rates, not raise them. There's no indication here in any of these that there's any likelihood that the Fed would raise rates. And what about gold? Well, interesting. This is an interesting picture. Gold has been just on a tear with all the geopolitical risk that's going on in the world right now. But what I find interesting here is you can see the price has been moving nicely higher. It has softened here a bit. You can see that the slope here is not as steep as it was back here. But what's interesting is ever since this inflection point where the slope started to moderate a bit, you can see that the selling pressure has been steadily increasing. And the buying pressure has been falling. So that's what I call a divergence, right? The price is increasing, but the buying pressure is decreasing and the selling pressure is increasing. That tells me that this cannot continue going higher for much longer. In fact, it might turn around and start to go lower unless this situation reverses. So be interesting to see how this looks next week. And what about Bitcoin and cryptos? Well, it had a really huge run up here, and now we're kind of sideways to down, going through this consolidation. Now, everybody's talking about the halving and that should have good effects on the prices. Well, it hasn't shown up here yet. And in fact, you can see that the selling pressure has increased a lot here and is well above the buying pressure. So right now, short duration, the only thing that looks good in this chart is that GBTC went up the last 2 days. So hopefully that'll continue and this will start to reverse. If there's one thing to take away from my market review this week and last week, it's that the equity and bond markets are still skittish and on edge. This is not a good situation. It says there's nowhere to hide. So my hope is that this logjam breaks at some point, and equities move higher and treasuries move higher. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Think Making this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips but the sun's stronger. Pour it out if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold but it's lonely, yeah. This life feels like the sunny water.